Welcome to Investing Ethos. What is this channel about? This channel is about doing deep dives into small and medium cap companies. We're looking at the ethos. Ethos is all about finding interesting companies at a large addressable market or at the inflection point in their business cycle. What does the inflection point mean? Inflection point means that they're just about to grow, but they haven't grown just yet. So we're very interested in companies that are nearly at that stage. How is this channel structured? This channel is structured in three ways. We're going to have the history video, which is this video, where we're going to go through who the company is, what do they do, what are their current financials, what they plan on doing in the future, the management, and the risks you need to consider. In the valuations video, we're going to be doing a discounted cash flow analysis. And using this technique, we're going to try to figure out how much we should actually pay for this company. And finally, we're going to tie all of this together and make a judgment call on whether or not we're going to invest and how much we're going to invest and what the potential returns could be. We're going to make this channel a bit interesting, and we're going to have a $10,000 virtual portfolio to invest for the long term. And using this money, we're going to try to find some of those interesting companies, and we're going to be doing a lot of those deep dives along the way. So sit back, relax, enjoy a glass of wine, and let's look forward to the video. Before we start, let's look at the disclaimer. Please note that the information that I'm providing you is of general in nature. There's no personal advice involved. I'm not a financial advisor, and I do not want to give personal financial advice. In saying that, let's go into the first company. Well, what is this company that we're looking into? This is Janison's. It's a very interesting company listed in Australia that provide digital assessments and digital learning tools in both the schools, higher education, and the corporate market. They are a very interesting company, and with a long history. They were founded in 1998 by Wayne Holden and his wife Jackie. Both of them thought back in the 1998, which is during the dot-com era, that education should be online, it should be transformed. Because remember, back in the day, everyone wanted to create a website and put everything in the internet. It was during 1998, it's the time of the internet. And they thought, why can't education be online? Why do people still have to go to a classroom to learn? Why can't you learn online? So what they decided to do was they built the business with the money that they ever had and built it up very slowly. It took them a long time to establish customers, establish a brand. Because when you think about it, they're building a business in a market, the education market, that is very slow moving and very strict. A lot of the big institutions, a lot of the big governments, they do not want to give a contract to a startup company or a company with less than 5 years of operating experience, because they want to make sure that when they're giving a contract, it's a company that have a history. So for around about 12 years, from 1998 all the way out to 2013, the company had to do it the tough way. They had to build relationships, build customers, and establish their technology. And in 2013, they really did that, because they signed an agreement with Microsoft to put their technology stack into the cloud, which is a really good idea. Because when you think about it now, all businesses are using the cloud. Janison is one of the early companies that decided to do that during the cloud era. And they're putting their technology through Microsoft Azure as the platform for use. So during this time, they had to build this technology out, and it was all about the foundation stage. Then they start to get to the establishment stage. This involves listing their company in the ASX. When you list a company going from private to public, you get access to capital markets that you wouldn't have in a private company. By getting the access to the public market, they could raise more capital when they need to, and it becomes much more easier. So by listing on 2017, they decide to start to expand. They're still consolidating. So by expanding, they mean they did acquisitions to increase their product offering. So they acquired a company called Ascender, I believe in 2017, just to increase the product suite for the learning business. And then they acquired a business called LTC, where they paid a lot of money for this, $12 million, who are responsible for monitoring exams. So LTC have clients, 15-year, like long clients that have 15-year relationships, like IDP Education, who provide the tests for international students coming to Australia. So this is the English language test that IDP have, called IELTS, which a lot of international students know about. This test is mandatory. It's mandatory to determine what level of language skills you have, and to see if you can enter Australia and study Australia, and be part of doing a degree in Australia. So it's very important relationships that LTC, Language Testing Consulting Services, do, and Janison paid $12 million to acquire that business. So the reason why they acquired it, as well as also another strategic point, is Janison wants to provide both online and physical examinations. So if you're a customer, if you're a government customer, if you are a school, if you're a higher education customer, and you want to give a tender to a company that provide the exams online or through in person, Janison can cover both. So that's why they acquired LTC. Then moving forward, in 2020, which we are in right now, they really established themselves as a global education assessment provider by winning the contract of OECD. So OECD is a group of 90 countries around the world that have an exam called PISA, which is to test 15 to 16-year-old students who have completed compulsory education to see if they have skills that are relevant to the modern society. So the skills that they're looking for are math skills, scientific skills, and English skills, right? So this test is just to see if the students can live in a modern world after the compulsory education, see what the level of understanding is. So with this test, PISA test, that happens every 3 years, OECD goes around the world and give out the contract for 1 or 2 technology providers. Janison did not compete in the PISA test, but they did compete for the PISA for Schools test. So this is the PBTS test. This is an annual test, unlike the PISA test, which is happening every 3 years. Janison is an online provider of education solutions. So they managed to convince OECD to make the exam digital. And this is before the coronavirus. And by making it digital, Janison won the tender, right? And PISA for Schools is to see which schools in which country around the world is outperforming the other schools globally, or if your school is doing well compared to other schools within your own country. So it's a really good benchmarking test, not compulsory for students to do, but to see how well your school is positioned. So it's really, really important that Janison win this contract, because it further solidifies their global strategy. They bought this company called UNSW Global Education, which is really fantastic. They got it for $722,000. They paid a very cheap price, and that company has this test called ICAS, which is used globally in 15 different countries around the world. This is a test for students in years 2 to 12, and it tests their mathematical skills, scientific, and English skills. Very important test, and education assessment decided to be like, you know what, we don't want to do this test. We can't do this test, we can't do it online, and they decided to spin it off. The reason why they couldn't do it online is because they had another product called Reach, which was meant to be the online test for ICAS. However, parents really did not like it because they had very bad communication, a lot of lead-in times. So when a parent wants to know exactly how the test would be run for their student, for their child, Reach unfortunately was not able to be quick with the response to let them know exactly how it works. So when that happened, they lost 50% in test volumes for the ICAS exam in the same year. So we can see the consequences of doing an online test wrong. It hurts the actual product that you are actually giving out, which is the ICAS exam. So because of all this fallout, Education Assessment decided to spin off that division, and Janison bought them for $722,000, which I think was very, very cheap and a really good acquisition. because ICAS alone brings around $7 million per annum, which is a really good acquisition. So now we had a bit of a good idea of what the company is and what they've been doing, how they've been growing, like what they've been doing in terms of acquisitions and what they plan on doing going forward. Let's look at what they do in a bit more detail. And this is where a lot of YouTube financial people just stop and they have a new video and things like that. But this is a deep dive. Deep dive means we're going to go right into it. So let's really look at what Janison does. They have two businesses. They got the assessments business and the learning business. Assessment business is education assessment. They provide solutions for any schools or higher education customers to set their own exams. So how would that work? You got the customer has to pay a project service fee, which is a compulsory fee, and you have the recurring revenues. So what does that mean? So a project service fee is an implementation fee or an integration fee. So if I'm a customer, if I'm a school and I gave a contract for Janison, 25% of that contract I have to pay upfront, because it's all about the implementation, how my school's database fits with Janison's IT structure and all of that stuff. So once that is completed, then I have to start paying recurring revenues. So 15% of the recurring revenue will go towards support. So if I need any help, or if there's any sort of clarifications, or if there's any sort of account management, 15% of those revenues go towards support fees. The other 60% revenues goes towards the licensing and the hosting fees. So if I want to make sure that Janison maintains, that I keep my content, keep my exams in the Janison platform, I have to pay a recurring revenue. And that 60% comes from licensing and hosting fee. However, I might also have to pay in the future potential additional fees, and this is the growth driver for Janison. If I already signed a contract with Janison for 20,000 tests, and then next year I decide to do 25,000 tests, for that extra 5,000 I have to pay an additional fee per test per student. So majority of Janison's revenue over the long period of time is by getting the customer to do more and more tests. That's how they can increase the average revenue per customer. And this is the assessment business. When we look at it from a holistic point of view, assessment business have been growing pretty good. 23% per annum, 23% CAGR for the past 4 years. That's very good. So that's from $11 million to $22 million. That's very nice growth there. Not really fast growth, but it's steady growth, and that's something that you should commend Janison's assessment business. The gross margins is 41%, so it's not as large as what you expect from a technology company. In the learning business, it's a bit different. So Janison has a product called Academy, and it's targeted towards government and corporates. So not the schools, not the higher education, government and corporate. So this product is designed for performance and compliance testing, learning modules. So the way they make money is very similar to the way they make money with the assessment business, by first having a project service fee. So if I'm a new customer, like let's say I'm a bank, I'm like National Australian Bank, and I just decide to agree on a contract with Janison's learning module, learning software. I pay 25% of the contract upfront for integration between my banking software with Janison's IT, and then the remaining fees will be recurring revenues, right? But what's different is that instead of being revenue per test, because there's no test, it's revenue per employee. So if I have a lot of employees and I need to train a lot of employees, I pay additional fees for Janison. So that's the learning business. So what does this tell about Janison? Well, it's simply Janison's growing their assessment business much quickly than the learning business. So learning business is growing around 4% CAGR, while Janison's assessment business was 23% CAGR the past 3 years. So the learning business is growing very slowly, Janison's assessment business growing very quickly. Janison's assessments business is worth 2/3 of the total revenue in 2020. So you can start to see that the assessment business is making more and more of the revenues for Janison over the long period of time. But in saying that, The learning business have higher gross margins. So they have 55% gross margins, while Janison's assessment business is 41%. So the learning business is much more profitable. When you're looking into this company, please keep in mind that there are some risks involved. First being, because it's so tightly owned, liquidity is it's a bit of a concern if you're a shareholder. So you can't go in and out of shares because you're already paying a brokerage to get a position, and you're going to have to take another brokerage to get out of the position. You're paying additional brokerage for this company. Because it's illiquid, doesn't get traded a lot in the stock market, so you're going to have difficulty in getting out of your position. In saying that, that means you've got to be a bit more long-term in your holding. You've got to be a bit more long-term in your thinking when you're investing in this company. Another thing is financials. They haven't really shown that they've achieved free cash flow positive, even though they said so. So you've got to have to wait a while until you feel comfortable that the company can sustain itself. But the biggest risk that I see with the company is acquisition. They have been overpaying for some of the acquisitions, no doubt. LTC, they paid $12 million and they were meant to get $3 million in June. That's when a lot of exams going to be happening, and that's when most of their revenue should be happening. But unfortunately, because of coronavirus, they didn't get that revenue, and those exams are going to get deferred in the future. So by not getting that revenue, right, Janison is missing out on that, and they've definitely overpaid for it. So that's an acquisition risk I see happening, and they want to mitigate that by getting a third-party M&A advisor, which I do not know if it'll be a good thing or not. So that's a risk. That is potentially a risk on how well they can work with the M&A advisor. So you have a good idea of what this company is all about, what they've done, what they're going to do, what the market opportunity is, what's been happening so far. Let's just summarize 3 things that we can take away from this company when you are looking into it. First is they're an established company. They have been in the market for 20 odd years, which is really, really impressive, which means this is not just a startup. They have gone through the startup phase and they're about to enter the inflection point, the growth phase, right? They've built strategic customers throughout their time. They've built a lot of relationships. They've built a lot of long-term relationships. They've acquired a lot of companies, and they've enhanced their product suite, and they're now about to enter the growth phase. The second takeaway is the growth phase. The growth phase that they have calculated and they've announced to the market is they're planning to increase their revenues from $22 million to $150 million in 5 years' time, which is big, which is massive, right? Which is a very fast growth rate than what they've shown historically. So you have to keep in mind that because of those lofty targets, you're basically relying on management to get there. If you really do trust them, then you can go with them. And finally, they're operating in a space where everyone believes that it's going to be of complete importance after the pandemic. The pandemic has shown that companies that go digital, that are either in the healthcare or education or whatever sector they are, they're going to do well. This company is digital. Despite having LTC as for facilitating exams in an in-person setting, their prime objective is to deliver exams digitally. And post-crisis, governments are going to increase their budget on healthcare and on education. And by doing that, what would the education institutions would spend it on? They're going to spend it on digital education, digital online learning, and online examination platforms. And Janison will be right there. They could potentially win those customers because those customers were very slow at moving to digital in the first place, prior pandemic. But due to the pandemic, it has really shown why an education institution provider like UNSW or Macquarie University or other universities around the world, as well as schools, why they need a company like Janison's to make sure that they can do the tests online and set tests online, which is much quicker, much faster, and they can rely on Janison's technology to make sure that the tests are safe, because Janison, I forgot to mention, in the product suite is they have an AI component where when you're doing a test online, they have a camera that records your face to determine if you're cheating or not, which is really useful for an education provider, right? Because it means that you need to spend less resources on that. So in conclusion, you've experienced a deep dive on Janison's, which is a very interesting company and a company that should definitely be on your watch list in the long term. Stay tuned for more deep dive, more analysis. Next video is all about valuation. We're gonna now take what we've understood from the company and put it into numbers. And afterwards, we're gonna make a judgment call whether or not to invest or not invest in this company. Thanks for watching. Please give a like, comment, or subscribe, or if you have any feedback, feel free to share, and I look forward to seeing you soon and look forward to joining you during the journey.